The Reserve Bank of Australia this week just hiked the official cash rate once again after inflation continues to worsen, despite new data showing that it is already having a massive impact on housing prices across the country. Head of the RBA, Phillip Lowe, has been under fire recently for potentially misleading property investors who flooded into low variable loans during 2021 and are now facing sharp increases in their mortgages. Today, I want to talk about all of the latest information that we have on inflation, interest rates, and the housing market so that you can better understand what is happening right now and what to expect going forward. Now, I want to be clear, I could sit here and speculate to you about what I think house prices or interest rates will do, but ultimately both of those things are going to be influenced by what inflation does, which is an unknowable factor. I never want to come across as if I have some crystal ball that allows me to see into the future and see what inflation and house prices are going to do. I wish I did, but I don't. But there is a lot of value in understanding the mechanics of how each of these factors influence each other so that when you're watching the news and you see there's a new rate hike or that inflation has gotten better or worse, you understand what is likely to come of those factors in terms of how it affects your mortgage payments or how it affects your stock portfolio. I know I go a little bit overboard on the titles and thumbnails sometimes, and I do apologize for when I've missed the mark on those, but hopefully the content of my videos always demonstrates my core message, which is I want to teach you about the mechanics and not really be making predictions about what I think will happen. So this week in Australia, there was quite a bit of news that came out around the RBA interest rates in the housing market, and I just want to dive into all of the different things that are happening just to keep you up to date with what to expect going forward. The big news this week is that the RBA increased the official cash rate once again. They increased it by 0.25%, which brings the official cash rate to 3.1%. Phillip Lowe, head of the Reserve Bank of Australia, also released a statement where he announced the interest rate hike and really gave some background on why the RBA believes they need to continue to raise interest rates. And the main reason for that is inflation. Historically, inflation has only been reported quarterly in Australia. Last month, that changed. We're now seeing inflation data in Australia every single month, so we can keep a closer eye on what inflation is doing and therefore understand a little bit more about what decisions the RBA is making on a month-by-month basis. The latest monthly figure was 6.9% annual inflation, which was a decrease from the previous month in September, but 6.9% is still way above the healthy 2 to 3% range that the RBA would like to see inflation within. On top of that, with extra data that the RBA is looking at, they don't actually expect the recent decline to continue. In fact, they think inflation in Australia by the end of the year will have reached 8%. The RBA briefly reiterated some of the factors that are influencing inflation. We've spoken a lot about these factors, so I'm not going to go into the details of them here, but of course it includes the war in Ukraine, things such as the COVID policy in China and how that's affecting supply chains. And then they also mentioned that just looking at domestic demand for products relative to those lower supply levels is also contributing to higher inflation in Australia. And even with the large amount of interest rate increases that Australia has done and may continue to do over the next year, the RBA still expects inflation to run pretty hot in Australia for a long time. They now expect that inflation won't get down to 3% until the end of 2024, which means that next year and even through 2024, inflation is expected to still be well above the healthy range, which essentially means more rate hikes are likely going to be coming. I'll talk a little bit more about whether we should trust these expectations towards the end of the video, but for now, I just want to give an update on what the RBA is saying publicly. Those rate hikes this week were, of course, immediately passed on by banks to mortgage holders. And that means that an owner-occupied variable loan now averages 5.45% in Australia, and a 2-year fixed rate is now 5.8%. The 0.25% increase represents a $75 per month increase on a $500,000 loan. That's 25 years. $75 is a lot for just a 1 monthly interest rate increase, although it's not an astounding amount. But what is crazy is the total amount that mortgages have gone up since May when rate hikes began. On that same $500,000 mortgage, payments are now up $834 per month on average. That is since just May this year, which is crazy. And Phillip Lowe, particularly at the RBA, has been under a lot of pressure in regards to this, especially since it was only a year ago that he essentially promised Australians that rates wouldn't be going up until 2024.
In some of these, the conditions for an increase in the cash rate could be met during 2024 while in other scenarios these conditions would not be met.
At the time that Lowe made this statement, Australia was still partly in lockdowns, the economy was in pretty bad shape, and it seemed unlikely that inflation would surge just a year later. And it seems like those statements may have contributed to a huge amount of Australians taking out or getting their loans refinanced during 2021 when rates were extremely low. 1 million new home loans were written between February 2020 and 2022, and of those, 280,000 households took out debt that's more than 6 times their income. Those on variable loans have gone from paying about 3.5% interest to now almost 6%, and even sharper if you looked at those who were able to lock in a 2-year fixed rate in 2021 at around 2.2 to 2.5%, they'll now see their mortgages jump to around 6% when the fixed period expires next year. And on this, Phillip Lowe actually came out and apologized to Australians for the way that he worded his statement a year ago.
I'm certainly sorry if people listened to what we'd said and then acted on that, what we'd said, and now regret what they had done.
And it makes sense that Phillip Lowe would come out and make this apology now because interest rates have gone up so much and mortgage payments have gone up so much. But also in the press release, they indicated that the RBA expects that they will continue to raise interest rates for the foreseeable future to get inflation under control, which essentially means that even though mortgage rates have gone up an astounding amount, $800 per month for a $500K mortgage, the RBA is expecting to continue to raise rates and those mortgage payments will likely continue to go up. And we really don't have any visibility on how high they will go or where this kind of ends. And while interest rate hikes tend to have a pretty lagged effect on the economy, in terms of home prices, they have already seen significant declines in price, very likely on the back of some of these interest rate increases. I spoke about the falling house prices in my previous property video from a couple of months ago, but we do have new monthly data for major Australian cities. Sydney in the latest month is down 1.3%, Melbourne was down 0.8%, and Brisbane was down 1.8%. And since last year, Sydney and Melbourne are down 10.6% and 6.9% respectively. And those declines, at least in part, reflect people who were on variable mortgages who saw their mortgage rates go up so much and needed to sell their houses. And if we assume that at least interest rates don't decline over the next 12 months, we're going to continue to see these short fixed term mortgage rates roll over and people will be moved onto the new higher rates, which in some cases are 2 to 3 times higher interest payments. I think it's likely that we may very well continue to see house prices have downward pressure from people selling. So is that what we should expect going forward into the next year? That house prices are going to continue to fall or collapse and that things are going to get worse? Well, ultimately, while we can see what's happening right now in terms of economic conditions, what's going to happen even over the next year is heavily dependent on what inflation does. And as I mentioned at the beginning of the video, that's an unknowable factor. So we need to recognize that whatever happens to the economy, pretty much everything else that happens is going to be dependent on what happens to inflation. So we can watch inflation and understand what the ripple effects are likely going to be, but we can't predict what those ripple effects will look like because we can't predict inflation. But the core mechanics essentially work like this. The RBA wants to see inflation between 2 to 3% because anything above that means that the country has no price stability and it hurts particularly lower income people who are seeing their everyday expenses such as rents and grocery expenses go up considerably. So the RBA wants to see inflation come down to the 2 to 3% range. So as long as inflation is well above that range, remember we're at 6.9% at the moment, as long as it's well above that range and not showing signs of sharply coming down, essentially we should expect that the RBA is going to continue to raise interest rates and the banks are going to be very likely going to be passing on those rate hikes to customers, to mortgage customers, which means that as long as inflation is staying well above that 2 to 3% range, you should expect that mortgage rates will continue to rise. But I don't want to be all doom and gloom because it was only a year ago that we had very little inflation and now we're in a massive inflation crisis. And that should indicate to you that economic conditions can change very quickly and they can get better very quickly as well. So the wide array of outcomes over the next year or so it's massive. There is a massive array of outcomes. On one hand, we could see inflation remain high for another year, and that means we could see interest rates continue to approach the 5 to 6% long run average, which is about 80 to 100% higher than they currently are. And that's kind of one end of the negative extreme. The positive end of the extreme is we could see the Australian economy slow down significantly, inflation drop off significantly, and we may even see the RBA actually have to lower interest rates to stimulate the economy if it goes into some kind of recession next year. What we're going through in Australia right now economically, and really what a lot of parts around the world are going through, is an abnormal economic circumstance, but it does kind of hopefully remind you of the importance of staying on top of your finances at all times, because economic instability can happen so quickly and when you least expect it. If you're really good at budgeting and saving and investing and, trying constantly to try and increase your income to improve your financial stability, then you are better able to brace for these quick economic changes. And while, of course, I don't have a crystal ball, as I mentioned at the start, I'm an optimistic person, and I think that the RBA's interest rate increases will have a solid impact on reducing inflation, and that we can return to a period of economic stability in the relative near future. This video is sponsored by SHARESIGHT, a comprehensive portfolio tracking tool that automatically tracks the performance of your investments so you can say goodbye to Excel spreadsheets forever. Unlike data provided by most brokers, SHARESIGHT considers the impact of capital gains, dividends, brokerage fees, and currency fluctuations when calculating returns, which gives you a complete picture of your portfolio's performance. SHARESIGHT tracks shares and ETFs across 40 different stock exchanges, 100 currencies, commodities, and even cryptocurrencies and unlisted investments such as private equity. Plus, SHARESIGHT makes tax time a breeze by giving you a simple but comprehensive view of your capital gains and dividend income impact. Use my referral link in the description below or head directly to sharesight.com/Hamish Hodder to try SHARESIGHT for free or receive 4 months of a yearly subscription.